Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, Wednesday, March 27th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. Currently, we do have futures up again, but I feel like it's Groundhog Day. I mean, it's third day in a row we've seen futures up, but the last 2 days we've seen selling throughout the day, taking us back down either in the negative territory or at least shrinking those gains that we see in the opening bell and in the first 5-10 minutes. So I guess today the question is, will it hold? The IWM in particular, which is the ETF that tracks the Russell 2000. Of course, that's a small cap area of the market. That's been an area that's been lagging for a long, long time. It has been on the doorstep of a pretty key breakout. I've been talking about this 208.21 level, 208.21. If we can get through that, that's been the highest candle body on the chart. And I like to follow the candlesticks, which I do want to mention Monday at 4:30 p.m. This coming Monday, April 1st, not a April Fool's joke. We are going to be doing a absolutely free candlestick course. It's going to start at 4:30 p.m. Eastern time on Monday. Everyone's invited, all of our members, all of our EB Digest, those of you who aren't either one. You do need to register, though, for the event. And I will be talking about that a little bit later, but just to give you a quick snapshot, again, I'm going to be talking about reversing candles. Those are candlesticks that I use a lot in trading. I know one of the big questions that I get a lot of times is, when do I sell? If you're a trader, that's one of those things that probably is a question that comes up quite often. Candlesticks answers that question for me many, many times. Anyhow, let's go ahead and take a look at what happened on Tuesday. Give you a quick update on that, the moves, if any, that were made. And like I said, a lot of disappointment again after a pretty strong morning session. The Dow Jones Industrial Average finished down 31 points. That was less than 1% drop, but again, we were up more earlier in the day and reversed off of it. The S&P 500 down about 15, which was a little more than 0.25%. The Nasdaq 100 down 0.36%, so a little more than 1/3 of 1%. That was down still above 18,210. We did hit we did get a breakout late last week, but we've been struggling this week. Morning strength, not as much as on the small caps. We have seen a little bit more strength in the small caps in the morning, but still, we've been seeing that erosion in the afternoon. It's not a lot, and the market is set, to maybe consolidate for a while, which is really what it's been doing. I mean, we keep inching a little higher, setting some new highs on the S&P 500. But for the most part, I mean, if you look back over the last few weeks, we really haven't made a whole lot of movement to the upside. But it's just one of those steady, slow, boring, frustrating, if you're on the short side, frustrating kind of moves where it looks like maybe we're going to roll over and then we just all of a sudden, we're back at another new all-time high. But the S&P 500 has definitely slowed down. And it's honestly, this time of the year, we do tend to see a little bit more sideways consolidation or even a little bit of selling. Not really seen a whole lot of selling, but we have seen that sideways consolidation, and maybe even on the long side, maybe a little frustrating if you grew used to getting up to some pretty nice gains just about every day, starting back at the end of last October. And that, I don't know, that feeling has kind of changed a little bit. We're not really seeing a lot of big gains. Instead, just kind of meandering sideways, and then every once in a while making a little bit move to the upside. Anyhow, it's still not bearish. We're still trading above moving averages. Moving averages, the short-term 20-day above the 50-day moving average. If you look at the AD lines a little bit off their recent highs on the Dow, S&P, and Nasdaq, but nothing big. I mean, we're still talking about a major uptrend in the AD lines. Mid caps finished down 5 points yesterday. That was a little less than 0.2%. Again, AD line still fairly strong. We've seen just a little bit of a pullback the last couple of days. And that's mostly because we have been finishing on the lows. The AD line, the volume is the multiplier. And you've got the action, which, we're not seeing a lot of selling. If we saw the S&P 500 finish on the low and we lost 2%, we might see a little bit more volume. So maybe we take a little bit more of a hit on the AD line. But by finishing on the lows, pretty much the entire volume gets subtracted, even if it's just, the losses are just minuscule. So you have to understand the way the AD line works. And same is true on the upside. I mean, you can have a very low volume day, but finish at the close near the high or on the high. And all that volume for the day, even though it's lighter than normal, gets added 100% to the AD line. That's how it works. So when I look at the AD line, the first thing that hits me when I have a strong AD line is that I think of the stock or the index or sector or whatever you're looking at closing, having a tendency to close strong. And we haven't seen that the last couple of days. And so that's something that's maybe a little bit new, but we haven't seen breakdowns. So it's, like I said, it's a little bit of choppy, a little bit of frustrating action, especially like for me, I'm really waiting for this IWM to take a big jump, maybe close one day at 212, 215, instead of this 204, 203 up to about 208 area where it just seems like it's been churning for most of the month of March. Actually, we did have one dip down just below 200, but for the most part, especially the last week or so, just kind of hanging right in this area, right beneath the breakout level. Again, that number for me is 208.21. So watch that. Transports after going down, hitting that low 15.4, went right up and hit the high at 16.2. At the bottom, piercing candle. At the top, and you're not going to be able to see that on this chart, very small, but you'll see it when we take a look at the individual chart on transports in just a minute. But at the top, 16.2, we printed a black candle, which is a reversing candle on the top after an uptrend. So it is just literally stuck in this trading range right now. So I'd like to see a breakout there. Transports to me, it's part of the Dow theory. So whenever the Dow Jones is up setting new highs, I mean, we're up near 4,000 or 40,000, I should say. You've got a lot of folks that don't believe in the rally because the transports are not breaking out to new highs. I mean, look at the Dow. You can see doesn't take any kind of additional degrees or anything to see that the Dow Jones for the last couple months has been going up and the transports have been going sideways. They're not supporting the Dow. So the Dow theory is that you want to see both of these breaking out at the same time, or one at least breaking out to follow the other. We haven't seen that yet. So this is one area of the market that I would say is, got like a little caution flag that's flying right now. We want to see that breakout on the transports. That would confirm what we're seeing on the Dow, what we've been seeing on the Dow. But for right now, it's consolidation. Railroads probably could use a little bit more of a boost. Truckers have been pretty strong, but the railroads could certainly use a boost. Anyway, watch that recent overhead resistance on the transports, because if we get that breakout, and a lot of times transports and small caps will go together, which doesn't make sense in that most of the Dow transport stocks are larger companies, not really in the IWM, but they both are solid based on if the domestic economy is strong or strengthening. I mean, if you think about small caps mostly are companies that do business in this country. There are some that do business overseas, and I don't know the statistics, but I would guess that the percentage of revenue on companies within the IWM are much, much closer to 100% US than, say, looking at the S&P 500, which is multinational, and you're going to see revenues from all over the world. So the IWM is much more dependent on the US economy. And transportation, think about what transportation stocks do. Railroads, truckers, they ship goods in the US. I haven't seen any truckers going across the pond over to the UK. It's, what's transported, what the goods that are being transported here in the US. So if the US economy is strengthening, these two do have similarities. And so they don't always go together, but occasionally you will see them kind of heading in one direction at the same time. So anyway, keep an eye on those two, because I think these two really hold the key in the near term for the stock market. I know the mega caps and all, they've been continuing to do pretty well. We've seen some rotation into the big, large cap financials, many of the large cap banks. But if you look at the mid and smaller cap, the regional banks, you look at the KRE, still not keeping up anywhere near with the, the JP Morgans of the world. So small caps, transportation stocks, these are two areas that have been lacking or lagging. Either one works. And so breaking out in those two would be certainly a boost to the overall market. All right, down below, I've got 6 sectors today. I didn't do any industry groups. I just did the 3 groups, the 3 sectors that performed the best yesterday, and the 3 that didn't. And if you look, you'll see healthcare, financials, discretionary. Okay, healthcare is kind of I don't know, maybe a half breed. You got some aggressive areas like biotechs, even medical equipment. Some of the companies that can grow their earnings pretty strong. But then you also have defensive areas. You've got the healthcare providers. You got pharmas. Pharma's pretty defensive. Their earnings tend to be pretty steady, fairly predictable. Anyway, you got this group leading, and then you've got 2 of the 5 aggressive groups in the second and third spots, financials and discretionary. So that's good. But then when you turn to what wasn't working yesterday, you can see a little different flavor. You got utilities and real estate both in here, which are defensive. So if you're looking at yesterday's action, and the reason I'm pulling all this up is yesterday's action, even though we sold off and even though we didn't finish great and we saw some losses across the board, when you look at the sectors yesterday, it wasn't like there was a mass sell-off of the aggressive areas and folks were moving into defensive areas. So it still kind of has that feel like market wants to go higher, in my opinion. And this was just one day, but I've been watching a whole lot more than one day. Financials and industrials have really taken over the market over the course of the past couple of months, along with energy. But energy is neutral. When I look at energy and materials, I don't really think of them as aggressive or defensive. I've seen both those groups work in any kind of market or lag in any kind of market. I mean, a lot of the secular bull market that we've seen 2013 till now, energy has been a massive laggard. But recently, you can see it's very strong. I just have a problem overall with their relative strength of energy and materials because the dollar remains in an uptrend, because the US 10-year Treasury yield continues to strengthen relative to Germany's 10-year Treasury yield. That's how I track the dollar. And in turn, when the dollar is strong or strengthening, over time, energy materials underperform. That's been the history of the stock market. So it's not that I don't like energy in the near term. I can see an uptrend when one occurs. I mean, we're in an uptrend. As long as that continues, you can trade energy stocks. I just wouldn't get married to them because if this dollar continues to strengthen, and energy, by the way, is the strongest sector during the month of April. I can pull that up for you in just a second and show you that. But energy loves the month of April. And we're in an uptrend. So you would think that that would continue given history and given what we're currently looking at. But I would just say, again, the long-term strength and uptrend in the US dollar, and I'm talking about since 2011, has sent energy and materials down relative to the S&P 500 for this entire period. Yes, we've had some pops once in a while, but those pops tend to not last. And then they go into a period of significant underperformance. So you just have to understand where you are right now with energy, which is we're in one of those pop phases relative to the S&P 500. But when that bubble bursts, you're not going to want to be trading energy any longer. Could this be a long-term play to the upside on energy? Sure. I mean, dollar could weaken. Maybe we go through one of these extended periods where the dollar is going up and energy goes up. I mean, there's no guarantee. I'm just telling you what the tendency is, what the history is of the stock market, and how the inner markets generally play out. And so I would just be careful with energy. Cautiously bullish maybe is a great way to put it. You can't argue. We had that breakout. We kept talking about it on the way down. It was trending down. We needed to get through $87. Well, guess what? This month of March, we got through $87. Now we're sitting at $92. So it's been a really strong month. But anyway, I just wanted to show you that sector breakdown. Let me show you, though, the seasonality on the XLE while I'm thinking about it, because I'll probably forget before the end of the show. But if we go back the last 20 years, you will see that energy goes up 68% of the time during the month of April. And it's averaged gaining 4.5% during April. And this goes back 20 years. This goes back into the bear market, secular bear market, and then throughout the entire secular bull market to date. So it's through a couple of different periods. And 68% of the time goes up, which is second only to March, which, by the way, we're going up in. So these are the 2 months. It seems to be a pretty good sweet spot for energy. But look at May tailing off. And if we compare the XLE to the S&P 500, now you can see over the last 5 years, actually last 4 years, because this year we haven't had April yet. But over the last 4 years, it's been up 3 of the last 4 in April. And if we drag this back 20 years, now on a relative basis, April is the absolute best month for energy, and it averages outperforming the S&P 500 by 2.4 percentage points. And you look across the bottom here, and really nothing else that close. I mean, the major outperformance besides April occurs in January and February. But you can see the chances of it outperforming in those 2 months are less than 50-50. So clearly, to me, April is the sweet spot for energy. And we're trading strong going into April. So I wouldn't write it off. It's not like I would say, hey, take profit to get out of energy now. But just understand history, the way the market typically works. Understand where we are. We've already had a pretty big move. So if energy continues to strengthen in the month of April, and especially if you start to see some other factors kick in, and I guess technical factors I'm talking about. So yesterday, one thing that maybe in the short term will hurt energy, we'll see, is that we printed a bearish engulfing candle. And if you look throughout much of March, it's been hollow candles almost all the way up. So yesterday, volume was pretty moderate. And we also had that reversing candle. Now, usually, well, not usually, but that tends to be a short-term signal, not a long-term signal. Candles don't give us long-term signals. They can coincide with other signals that give us long-term signals, but candlesticks by themselves are short-term signals. And I'll talk more about that on Monday. But anyway, if you go back, look at a longer-term weekly or even monthly chart, and you'll see here over the last 15 years, we're now sitting at an all-time, 15-year high. If we go back, 25 years, it's about when the sector ETFs began, right? Anyway, you can see looking back since the turn of the century, it's a high. So the XLE certainly has been moving and coming off the lows from the pandemic. If you look at the very bottom here to where we are right now, it's probably the best performing group since then. But if you remember back in 2020 during the pandemic, you could have made money by storing energy in your pool. It went negative. The price was negative. People would pay you to take energy or crude oil, not energy, but crude oil. So that's where we come from. But again, just know history, know what's going on with the dollar. Dollar's been going down or going up for a while, and the history is for energy to underperform. Doesn't mean, by the way, energy is going to go down. I need to make that point pretty clear. It just means it's going to underperform if the dollar continues higher. That's history. So anyway, harping on this, but I've had some energy questions of late, and in particular, why I don't talk about energy more, I get these questions anytime energy goes up. And it's just that energy and materials, especially energy, is just not an area historically that I've traded much of, because it seems like it's controlled by things that are outside our control. And when I say outside I mean the US, things happening over in the Middle East, for instance. I can't control that. A lot of times I don't see it coming. Nobody does. And energy can react very, very strongly to things taking place over in the Middle East in particular. So anyway, that's why you don't hear a whole lot out of me about energy. But if you're asking me for my opinion, it's bullish right now. If you're just looking at the charts tell us a picture. Energy is bullish. 10-year Treasury yield. Let's get a quick update, see where we are. Still kind of drifting lower, but it's been kind of a stubborn move to the downside. It's certainly not one of these rapid declines that we saw here, or even back at the end of January when we saw this decline, or even beginning of March. This one's been a little slower. We don't see a lot of big red filled candles, which would indicate that, of course, the price of bonds during the day are going up. So we're not seeing a lot of buying of bonds during the day. Instead, it's just been like this slow leak in yield. So a slow move up in, say, something like the TLT. But we do have a double top in place. We're still in this uptrend. This technically is a cup with a handle down to the 20-day moving average. I really wouldn't want to see this go down much more, because if we're talking about this cup, you don't want to go down more than 50% of the cup in a handle. So if you're talking about from 405 to 435, what's the midpoint? 420. That's 50% of this advance on the right side of the cup. 420, where are we at right now? 422. And we went down to 420, maybe Thursday of last week, something like that, or maybe Friday of last week, whatever. We got down to that 420 level. 50-day moving average right now is at 418.9, so 4.189 or 4.19%. So 419, 420, kind of a big level on a number of different fronts. So we want to watch that. If the 10-year Treasury yield does break back down again, personally, in the near term, not the long term, but in the near term, the way the market, intermarket relationships have been working, if this breaks down to the downside, I would expect that could coincide with an IWM breakout, because the two have been moving opposite one another for quite a while. So that's something to watch for if the 10-year Treasury yield breaks down. We've been seeing it, like I said, slowly move to the downside. We've seen that IWM continue to go up around that 208 level without being able to break through. So those two, I think you maybe can watch, at least in the near term, in tandem with one another. S&P 500, again, 3 or 4 days in a row. You can see that, we're closing at or near the lows, which in turn, you can see the AD line is slowly moving to the downside. Volume has been fairly light relative to what we had seen. Yesterday, we saw the selling pick up slightly, but it was still a fairly light day. So, we've seen, for the most part, bullish volume trends. You might look and say, well, what about this big candle right here? Well, you're going to see that every 3 months. Here, here, here. It's option expiration day. You always see high volume. It has nothing to do with whether you're going up or down. Whether the market goes up or down on option expiration day, volume is going to be high. And you're going to be able to see those just looking across the chart. Pretty much can make those out. So overall, I think the volume trends remain pretty strong. And that's why, again, we've been seeing mostly a strong AD line. So short term and intermediate term and long term, I'm bullish. Short term, I'm okay if we go down and touch the 20-day. That's kind of normal pullback. So, when I say I'm bullish, I never know when we're going to get a 20-day test. I mean, trying to get down to that level at the stock market, I mean, you're talking about getting a microscope out and trying to figure out what every move's going to be every day. I have no idea. But I'd look at it in context with the big picture. And so the big picture tells me we're going higher. The big picture tells me that it's normal to have 20-day tests. So in the short term, I believe we're going higher, but don't be surprised by at least a 20-day test. Nasdaq 100 continues to move higher. This one has slowed quite a bit on its in terms of its momentum. The PPO, you can see, just been drifting lower over the last few months. Money we've seen rotate into more value-oriented areas, not necessarily defensive, but more value-oriented. I mean, the S&P 500, I don't think of as a defensive index. I look at the S&P 500 as just more value-oriented than, say, the Nasdaq or Nasdaq 100, which is much more tech-dominated, much more growth-related. Those same stocks are in the S&P 500 for the, in large part, but they don't take up as much. They don't represent as big a percentage of the pie in the S&P 500 as they do in the Nasdaq 100. So those stocks, when they struggle or even just kind of go sideways or slow down for a period of time, that tends to hurt the Nasdaq 100 more than it hurts the S&P 500. And that's what we've been seeing. Nasdaq slowing down a little bit more than the S&P 500, but still in a bullish configuration. And that PPO is getting closer and closer to the center line, which is good in the sense for the Nasdaq, in the sense that we've seen the momentum return to zero without a big sell-off. Sometimes these divergences can simply be worked out by going sideways, and momentum just naturally comes back down and is no longer, negative divergences, which is a sign of slowing momentum. It's no longer a problem when the PPO gets to zero. That's when short-term and longer-term moving averages are the same. So if you got short-term moving average, which is equal to a long-term moving average, explain to me where the momentum is. There isn't any. So that's why the zero line to me on PPO, MACD, whatever you follow, the zero line is kind of neutral. You might think on the RSI, maybe something around 50 would be more neutral. Maybe it's a little below 50, maybe it's a little above 50, maybe 55, but right in that neighborhood is kind of neutral on RSI. Anyway, IWM, moving on. Here's that 208.10 level. See another cup. Here was a big cup. I've talked about this. I won't spend any more time on it now. But pulling back, hitting the 20-day wouldn't be horrible. That's only about $1 or so, maybe a little bit more than that from where we closed yesterday. But after printing a lot of hollow candles in the right side of this cup, the big longer term picture, I think beginning first half of February, you can see a little difference with all of these really strong hollow candles versus what we've seen a little bit more of the last 3 weeks as we consolidate. Seen a little bit more red-filled candles with a few big hollow candles as well. But again, we're consolidating. Watch 208.21. If that breaks to the upside, be very, very bullish for the small cap area. Transports. Again, here was that bottoming, reversing candle, downtrend, piercing candle. That's a reversing candle. Back to the upside, all the way back up to gap resistance and to this overhead price resistance level at 16.2. And on this uptrend, we gapped up and we failed. We printed a black candle. A black candle is filled. It's just like the red ones. The only difference is that we ended up closing higher than the prior day. A red filled candle closes lower than the prior day. So, putting it into more, everyday terms, if you were trading transportation, that's all you had. For instance, you can't really buy the transportation index, but play along with me here for a second. If you had only the transportation index in your portfolio, that's the only thing you owned, and you looked at the stock market at 4 o'clock every day, you didn't care what happened during the day. When you see a black candle, there was pretty much selling throughout the day, but when you look at your portfolio, it's going to be up from the prior day. These red-filled candles are telling you that there was a lot of selling during the day, but when you look at your portfolio at the end of the day, it's going to be down from the prior day. That's the difference. Anyway, again, we'll talk more about those candles on Monday. So head over to earningsbeats.com. If you haven't already, listen, if you're already a member of Earnings Beats, you don't have to do anything. If you're already on the EB Digest, our free newsletter, where you can subscribe and get charts 3 times a week for free, you don't have to do anything. It's for those of you who are maybe new to Earnings Beats or have never signed up for even our free Earnings Beats Digest. You'll need to be on that. But what you can do is click the register. It'll bring up the 4-part trading series, what we're going to be talking about. It's the first 4 Mondays of April. So we got April 1st, 8th, 15th, 22nd, all starting at 4:30. Mark your calendar and make sure you get registered. When you register, if you're not already part of the EB Digest community, you will be added. Again, if you're already a part of the EB Digest, or if you're a paying member at Earnings Beats, you don't need to register. We already have you. We'll send out room instructions and you'll be good to go. But for those who have not become paying members or are not even on our free newsletter, then you would need to register. All right, let's keep moving. So today's chart of the day, is EQT. And EQT is in the energy space. For those of you who say I don't talk about energy, well, I'm bringing up energy. So EQT has actually been one of the stocks that's been underperforming, though. While energy's been going up, what the heck's been happening here? Well, we've gone down and basically put in a double bottom. So that may be good. We've gapped down on big volume, sold off, but look at all these tails. And the thing that the tails do is that you don't see a lot of erosion on the AD line. I mean, if you look across, the AD line was going up when price action was going up. And then when it was going down, the AD line was still going up. And the reason is that you see a lot of these tails. And on a candlestick, that simply means these tails are intraday lows. The rectangles that you see that are either filled or hollow represent opens and closes. Again, I'll talk about this more on Monday. But when you have a lot of tails, it's telling you that you're not closing at the lows. You're closing well off of the lows of the day. And that's why the AD line is not going down. Could be a sign that this is significant accumulation that's taking place. So a little bit of manipulation maybe on some of these moves to the downside with buyers coming in the afternoon. Sounds like Wall Street accumulation to me, but you don't really have any kind of evidence of that until you start seeing the stock trend higher again. I think we got to get through that 38.25 level. The good news for this stock, and what I pointed out, was not the chart. This is not what you saw in the EB Digest today. I wanted to point it out though. What you saw in the EB Digest was the seasonality of EQT. Look at the last 5 years, well, last 4 years, because again, we haven't had April 2024 yet. But the last 4 Aprils gone up every year, and the average is 33.5. Now, please keep this in context. This is where having perspective and knowing history a little bit will help you understand this. If you don't recall the pandemic, 2020, energy stocks, remember I told you crude oil went negative. They were basically giving crude oil away. Well, many of the stocks in April, when we rebounded in April of 2020, had unbelievable gains, like 100% or more. If you recall, we had energy, which absolutely exploded back to the upside. And so that percentage, and the way you can tell is if you drag this down to 1 year, it'll tell you this is how it did in 2024. Went up 5.4% in February. March was down 5.9%, this stock. April doesn't show anything because we haven't had April. But what about April 2020? So as I drag this back, this will send me back in years. 2023, 2022, 2021, 2020. April, EQT went up 106%. So when you're looking at averages, you're just taking all of the April percentages, adding them up and dividing by, in this case, 4. I mean, if we're looking at just the last 4 years or 5 years, which is, so that 100 and whatever percent it was, 102, 106, whatever, is what's driving this up to 33.5. If we eliminated 2020, we dropped down to 9.2% average. See how that jumped by? So when you look at seasonality, I always look to make sure that this bar, even in the seasonality report that I send out to our members every month, it's not just the average return in the month, but it's also how often the stock goes up. If a stock only goes up 40% in a month for the last 20 years, but it has an average gain of 12%, think about that from a common sense standpoint. Okay, it's gone down. It's up 40%, means it's gone down 60%. There must be 1 or 2 really big up moves that's skewing this average. And in many cases, that's what it is. But anyway, if we go back, we know that 33% average over 4 years is skewed. But if we go back 20 years, that average is still 11. And let's get rid of those first 4 years. I mean, I'll just go over here and we'll just go all the way to 2019. All right, so one more. So here's 2005 to 2019. It still goes up an average of 5% in the month of April, even without that huge month. But anyway, let's look at the last 20 years because this is what I do for the seasonality report. Here we've got not only 11%, which is definitely higher because of 2020, but look, it's up 84%. 2020 is just one year. This is basically telling us that of the last 19 years, because remember, April 2024, we haven't done yet. So over the last 20 years, there's 19 Aprils, and 16 out of 19 have gone higher. So it's telling us this isn't just about year 2020. This is something that happens frequently. So yes, EQT is challenging on the chart technically. But are you going to just blindly look away from, what normally transpires in April? I don't like to buy a stock just because of seasonality. So I need to see something on that chart as well for the EQT. And for me, that something would be probably getting back through the moving averages. That would be one thing. We should be able to run and maybe fill this gap. From here, when we gapped up here, we did eventually come down, fill this gap. I would expect the same. So I think we're probably going to go to 37.5. That's $2.50 from where we are right now. Anyway, it is 9:35. I wanted to just go over real quick CGC, which is, if you've been following these weed stocks, marijuana, pot, whatever you want to call them, CGC has been absolutely flying, as have many of the pot stocks. I mean, if you look at the long-term chart of CGC, I mean, you're going to see, look at this move. If you get in at the wrong time on these stocks, because they do tend to be pretty volatile. Here, you can see volume was picking up, but if you chase and you happen to get in at the top, it will be a painful lesson. Same here, August, September. I mean, if you catch these moves and you're riding them up, great. I wish you well. I hope it works out for you. Just look at history and see how these sometimes end. So just make sure you have stops in play. And when they move up so much, it's hard to know exactly where to put a stop in, because 2 days ago, or I guess that was back on Monday, you can see we were at 8. Later in the day, we went below 6. And then now, yesterday, we were right back up at 8. Here we are again, right at 8. So how much room are you going to give it to the downside? You give it 5%, and you could be out in the next 5 minutes or 10 minutes. So that's the hard part of trading these stocks. I know a lot of people get excited because they're moving up. They're risky, folks. That's my point. I trade and I want to keep I want to keep my capital. Yes, this looks enticing and you think, wow, I mean, if I get in at $4, wow, I could quadruple my money in a week. That sounds really good and tempting. Just remember, you can lose quite a bit in a very, very short time as well. And so I tend to stay away from stuff like this. I mean, it's one of the reasons why I don't really look at stocks that are under $5, because most of them are small cap. Most of them get a story. They get something and they'll pop, but you don't know when that pop's going to occur. And then if you chase, just good luck is all I can say, because I've had my own bad experiences with this. I don't trade them because, again, the risk is too great. I don't care how much they might go up, and when they go up, everybody talks about how, oh my gosh, this is going to be $100 stock. And then 2 or 3 weeks later, it's right back down where it was. So again, pay attention to the long-term chart. Look at the monthly 15-year chart. This was a, $500, $600 stock 3 years ago. It's now $7.35 after all this excitement. So just understand, I think this group still has a long way to go to try and figure out who the real leaders are long-term, and to actually have a business plan that creates value for shareholders over the long haul. In the near term, it's a crapshoot, so just be careful. All right, that's it. Let's take a look, see what's going on in the market. We're going to start our live trading room, by the way, in 22 minutes. You do need to be a paying member at Earnings Beats, but a 30-day trial will qualify you. So if you are back here, all you have to do is hit this start your no-cost trial button right there. You get 30 days for free. You have to give credit card. That's how we get you set up in our system. But you will have 5 weeks of these Wednesday trading rooms, starting with today at 10 a.m. So give us a shot. Again, 5 weeks, 4.5 weeks, 30 days is your no-cost trial. That is a pretty good lengthy period. Many companies are, like us, either will give you 1 week free, or maybe they'll give you 1 week for a small fee. We've done that in the past before, but we decided we want folks to try us out and see what we do at Earnings Beats. So make sure you check that out. Going back to the market right now, we see the Dow up 311. We're 39,594. So we are now within another 400 points, getting back up close to that 40,000 level. We've never seen it. We've never touched it. I think our high was just under 39.9, if I'm not mistaken, a few days ago. But anyway, we're up 315 points today. So we're getting back up close. Another 300 points is going to have us right near that all-time high and within striking distance of 40,000. S&P 500 up 0.6%. Nasdaq up a little less, about 1/3 of 1%. Nasdaq 100 up a little bit more though, 0.4 of 1%. Small caps, mid caps are leaders so far this morning. So come back, join us here again in about 20 minutes. Love to have you join our live trading room and take a look at the way we trade, the way we use all of our tools, all of our chart lists, how I follow the market, the intermarket relationships, all these different things. We talk about scans. We have scanning strategies that we use. All of this is discussed. I'd love to see you in about 20 minutes or so. So have a great day, everybody, and see you. If you're not in the trading room at 10 a.m., I'll see you tomorrow for Trading Places Live at 9 a.m. on Thursday. Have a great day. Happy trading.